Hey everybody, Chuck Barone. Monday, March the 13th, 2023. Now when we wrap things up on Friday, I thought we might have a crazy week coming up because we got a ton of data. But oh no, there's way more than that. Bank failures, a ton of uncertainty. We're starting Monday off. The crazy keeps getting crazier. Luckily, we got some people that can explain some stuff to us. Make us understand what the heck's going on and what it really means. Before we start the show, though, of course, like always, I just want to thank everybody, welcome you to the show, let you know how much we appreciate your support, guys. It means the world to us. Markets today, well, crazy day, not a big surprise. Stock market all over the place today, from starting bad, up rally, maybe blah, 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 ends up mixed day. The Dow down 90 points, S&P down 5, NASDAQ rallying 49 points, go figure. I think that the NASDAQ rally was just as a result of the government coming to the rescue of Silicon Valley Bank, going to make all their depositors whole. They were looking at billions, from what I understand, in the report I read, they had $210 billion roughly in assets, but only $151 billion of FDIC insurance. So we were looking at, $59 billion of uninsured money that was about to go bye-bye. So it looks like the government's going to eat that. And, well, I think that's the reason you had a rally on the NAS. Plus, you had some decent earnings today. Bonds, wow, what a crazy day in the bond market today. The 10-year down 18 basis points. That's a huge move, guys. 3.51%. Just sitting there. It's crazy times. It was down as low as 3.41% before, gaining back up to 3.51. The 2-year, though, bananas time, man. Down 57 basis points. 4.02%. We were looking at a 100 basis point spread that now, blink, 50. Inversion, remember what I've been talking about? It was getting wider and wider. Well, that got narrowed down quick today. And I'm going to go into a lot of detail about this bank failure and what it means. A dollar today, like everything else, a down day. A dollar loses a full point on the index, 103.64. Tough day for the dollar, but a tough day for the dollar means a great day for gold and silver. And gold having a nice day today, man. Up $44.20, settling, the last I saw, trading at $1,913.30. Silver rallying $1.22 per ounce, $21.84. I knew metals wanted to rally, and here we go. 2,000 gold, $25 silver, coming soon. Oil down today, actually below the trough number of 75, down $2.12, 74.41 per barrel. Oil not looking very strong. And Bitcoin to wrap up the day in the markets. Wow, big rally for Bitcoin today, up $3,186. Last I saw trading, $24,229. Now, I don't really follow the crypto space very closely. This is a monster rally. I'm going to have to dig into this a little bit and see what everybody's thinking, because that's just a huge move, man. Okay, let's talk about Silicon Valley Bank and there's 2 other small regionals that are already gone. Let's talk about why it happened, what the heck went wrong there. Let's talk about what it means to the banking sector overall. And especially, what does it mean for us as far as interest rates, as far as this inflation fight, and everything else we're dealing with in this economy? Not a great time for this, okay? Okay, so here's some of the details, the way I understand them. Silicon Valley Bank is a small regional bank, basically a friend to the tech companies and all those in Silicon Valley. Roughly $210 billion in assets before the collapse. They were a very successful outfit. They were doing great. The problem they have and had is the same problem all banks are going to have. Okay, so We've had low interest rates, basically zero interest rates for a long, long time. Well, these banks, when they make profits, when they have reserves, they invest those reserves in treasuries, okay? So if you're holding treasuries and all of a sudden the Fed spikes rates 4.5 points, well, that's going to affect the value of your portfolio pretty dramatically. So these banks, all of the banks across the U.S., are sitting on massive losses in their bond portfolios. Doesn't matter whether it's corporate, federal, municipal, whatever kind of debt it is, all featuring big losses because of this huge climb in rates, right? So this is the bank's reserves. Well, what happened with SVB, Silicon Valley Bank? Last week, everybody was getting worried about the stability of the bank. They had $42 billion in withdrawals in one day. $42 billion in one day. Obviously, they could not meet those withdrawals. Prior to that, they were forced to sell these bonds at a big loss to cover withdrawals. They were just hemorrhaging money, and they knew they couldn't make the withdrawals that they were going to be dealing with. So, boom, gone. And the government did not wait even 1 minute to step in and say they were going to make all the depositors at the bank whole. So now the government's going to eat this $58 billion difference, I guess. This is, ordinarily I would be for that. Because banks have individual depositors, small fries. But if you have more than $250,000 in your bank account and you're above the FDIC limits, well, I guess that wouldn't be a poor little guy, would it, right? But Silicon Valley Bank is mostly a business bank. I mean, don't get me wrong, there's individual accounts there too. But they're known for their Silicon Valley roots, man. They're known for the big tech companies having tons of money with them. And all of those big tech companies having big exposure to this collapse now, right? So the underlying problems was a collapse in the collateral for their reserves. And the collapse in that collateral then meant they couldn't meet with withdrawals, which then forced a panic and a run on the bank. $42 billion in one day in withdrawals blows the whole deal up. And that's what's starting to happen across the country as small depositors, the ones who aren't really going to get hurt, are the ones running to cash out of their bank accounts. But we're starting to see this. Now we've had, in the past 1 week, just last week, we had 3 banks go under. Silvergate, a very small regional bank, Silicon Valley Bank, the big headliner, and then over the weekend, Signature Bank out of New York, with $100 billion in assets, quietly turned everything over to the FDIC and their state government. Bad stuff. And we got more coming, guys. You got to remember, okay? All of these banks do business the same way, right? They borrow short. So they take your money in your savings account, your money markets, right? They pay you a little bit of interest on those. They borrow short, because you can get that money, cash it out anytime. It's basically short-term loans, overnight loans. And they lend long, 30-year mortgages. So they borrow at 1%, they lend at 5%, they make the spread. It's usually a wonderful thing. However, when you have an inverted yield curve, and it costs you more to borrow money than you can lend it out for, that's where you run into big problems. And that's what locked up the whole system back in 2008, 2009, and that's what is threatening to happen again. Okay? Now we got what I read today across the banking community in the United States. Banks are sitting on $620 billion in unrealized losses on their portfolio holdings, on their reserve holdings. The Federal Reserve now has opened up a window where they can borrow money at face value on these, because a lot of these bonds are treasuries. We know they're not going to default, right? So they're letting them borrow at full face value on these bonds, so they're not forced to sell them at big losses. When the banks were buying these bonds, interest rates were 1%, right? Now they're 5%. So your 1% bond really takes a big haircut when rates go to 5, because now that 1 has to become a 5 to make that bond marketable. You follow me? So they can't raise the rate on the bond, so the only thing they can do is hand over the principal, reduce the value of that bond, so you can buy it cheaper than the $1,000 face value, right? And then that balances out the overall yield. Wow, man, this is big, big, big problems. I don't believe that this is the end of it. It isn't. I was reading this, so there's up to 30 or 40 more banks that are a big threat. We know Credit Suisse is in big trouble. We know that First Republic Bank is in big, 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 big trouble. They're hanging on by their fingernails. So I don't know if this is going to be a big contagion where the whole banking system is at risk. We're going back to 2008. Although I got to give props to the people in the comments over the weekend, man. People were saying, oh my God, is this 2008, 2009 all over again? I sure hope not, guys. That took us it took us a long time to get over that. And what happens in these crises is the powers that be in Washington, our yo-yos in Washington, want to start pointing fingers. So there's always losers that get the scapegoated blame. And then they want to start rewriting rules, creating more regulation, more laws, which in a lot of cases, not all, but in a lot of cases, doesn't have the effect they hope for and just creates a giant pain in the butt for business, right? But this is just the beginning, guys. Banks teetering now. I'm sure the Fed's going to be in there with their stress test, but I don't know if they were really prepared for this kind of stress. It's just, I don't know how. I guess with this borrowing window open now, that solves that problem, right? But it doesn't solve the problem of the threat of a run, right? Because if banks get to the point where people want to withdraw money and they can't, they go to ATMs and the ATMs won't give them money. That's a big problem, man. That's a very big problem, because most people are going to want to get every single penny of that money out as soon as they possibly can. And then that threatens the entire stability of the bank, the regionals, and then from the regionals, nationwide. So scary, scary stuff. And I cannot tell you what a pickle this puts the Fed in now, guys. So here they come to the fork in the road, right? Do they want to save the banks and the economy, or do they want to fight inflation? I'm glad I don't have to make that call. Although personally, I would vote to still fight inflation. It's crazy stuff, man. And the rest of this week, we knew today was going to be a quiet day. There was really no data today. Some earnings. But the rest of this week is going to be huge. We got all kinds of stuff coming out. And like I do every Monday, let's go through some of this stuff, okay? So, Tuesday, tomorrow, huge day tomorrow, guys. We're going to get CPI and we're going to get PPI. On Wednesday, we'll get PPI. So tomorrow, we'll get the CPI numbers. They're expecting the top line number to be 6.1%, down from 6.4 last month. And they're expecting core to be 5.5%, down from 5.6 last month. Now, you remember last month, we got a surprise to the upside. They were expecting numbers to come down further than they did, which was a jolt to the market. So it's going to be fascinating to see how these numbers look, because if they come in hot, now that only adds way more pressure to the Fed, right? So that's tomorrow. On Wednesday, we're going to get the PPI number, which is the foreshadowing of the following couple of months CPI. The producer prices tend to go up and they get passed along to the consumer. So when you see the PPI going up, you can pretty much get rest assured that the CPI is going to go up following it, right? So they're expecting PPI to go up 0.3% month over month. Also, we'll get retail sales on Wednesday. We'll get business inventories, which is important. We'll get mortgage bankers index, and we'll get the manufacturing index. So big information coming Tuesday and Wednesday that's going to tell us a lot about where this economy is, right? As inflation still running hot, how are retail sales? How are manufacturers doing? What's happening in real estate? Big, big, big stuff. Thursday, well, we know what Thursday means. Thursday's jobless claims. Jobless claims, right? Also on Thursday, we'll get housing starts. We'll get a look at real estate building permits. We'll also get the Philly Fed survey, which is also an important measurement of the whole overall economy. So now, jobless claims could throw a giant wrench in the Fed gears too. Because if jobs come in super hot and you got a hot CPI number, wow, not fun times to be St. Jerome. He's really got his work cut out for him. And on Friday, to finish the week out, we're going to get industrial production numbers, which are expected to be up. We're going to get capacity utilization, leading indicators, which are expected to be down. We'll get the University of Michigan Consumer Index, which is also expected to be down. Fascinating, fascinating stuff. This is going to be a crazy week for these markets. There's just no certainty. These markets are going to move day by day because now you're going to have background noise with banks and you're going to have up in front of your face all this data coming at you. All of it very important, going to affect the way this inflation works, going to affect the way the Fed's thinking about this inflation. Now what does the Fed do next week, guys? What do you think? So first it was a quarter point. Then when the inflation numbers came out, they were hotter than they thought. Then it was, well, maybe we're going to get jobs were still hot. Maybe we're going to get a half a point. And the market started factoring in a half a point. Now today, Goldman Sachs comes out. They're predicting there'll be no rate increase in March. And if you're in the, I guess if I'm the Fed, they have access to a lot more data than I do when we do. But I'm going to be looking at, I don't want to spook the markets with inflation. So I'm going to have to raise rates. I'm guessing they'll stick to that quarter point. I don't think that'll rattle the market so bad. It'll show that they're still on the job as far as inflation goes. But, depending on how all these numbers come out, it might look like just not very much, right? So it's just going to be a fascinating, fascinating next couple of weeks. We got all these extra things coming at us now. Banks, that's going to affect the overall economy. Banks are going to start tightening standards now, making it way, way, way more difficult for people to get loans. It's just the snowball that I talked about back in June that was this big at the top of the hill is now starting to pick up size and speed as it makes it down the hill. I still say, even though this inversion shrunk pretty dramatically today, I still say there's a recession coming. I can't predict when, okay? But this cycle's been pretty strong for a long time. We're due to clean out some of the excesses. I really believe that's going to happen. Probably sometime this year, my guess would be. And as I get more certain about timelines there, we'll talk about that. But so now you guys know what we got this week. Banks. Silicon Valley Bank. Collapsing collateral, collapsing reserves. Big run, all gone. Now, we'll see how far it goes. I'm sure we're going to hear about more of this. Usually when one big one goes, another big one goes right behind it. Now, that's Michael Burry's prediction. So we'll see. But we're going to be here to bring it to you guys every day, just so you'll know you're getting the very best up-to-date information. You can always count on me for that, guys. My show may not be exciting. I don't swear. I don't make faces. I don't do some of the stuff a lot of these other commentators do. But I'm giving it to you straight. Real information you can use. Real information to tell you, to give you an idea of what's coming in the future, man. Not the long-term future. I'm not Nostradamus here, right? But the short-term future to explain to you what these numbers and what all this stuff means. I don't worry about going and getting your money out of your bank. Okay, it's probably unlikely that it'll be your bank that fails. But, keep an eye on things. Keep an eye on your bank stock price. That'll be the big indicator of what the market thinks the stability of your bank is like. Now today is not a day to look because banks every bank got hammered today, I think. Even brokerages, Charles Schwab I noticed got pounded. But keep an eye on that, be vigilant, protect yourself, be aware. We'll be back tomorrow with all kind of fabulous information. Until we talk then, guys, we really appreciate your support. See you tomorrow. Thanks.